Good evening, everyone. Uh, Today is March 25th. We have Brian Feroldi from the Motley Fool. We're happy to have him today. So I think we will start with Mashab's questions, then we'll move on. So Mashab, if you want to start.
Yes, hello, Brian. So our first question, you would like to know more about yourself and you would like to know more about the Motley Fool. The Motley Fool is highly followed in the Middle East, but can you please give us a brief introduction about it and about yourself? We would appreciate that. Thanks.
Sure. The Motley Fool is a global investing community and service. It was founded more than 25 years ago by David and Tom Gardner, who are two master investors. The company has global operations and millions upon millions of readers around the world. It's been a champion of individual investors and individual shareholders since day one, and they just expound basic, down-to-earth, simple, easy to understand, business-focused investing principles and philosophies. Believers in long-term buy and hold strategies. You look for great companies with great management teams and great opportunities and great economics. You buy those companies and then you hold them voraciously through thick and thin. The Motley Fool has done spectacularly well following that exact philosophy since day one. They've recommended numerous stocks that have gone up 10, 50, 100x in value. And I myself was a paying member of the Motley Fool for several years. I kind of caught the investing bug in around 2004. That's when I graduated from college. I never knew anything about investing, personal finance, anything of that stuff. I just kind of picked it up on my own after reading a couple of books on money and personal finance that interest me. That gradually led me to find Fool.com and the Motley Fool. I really became aligned with their investing philosophy because when I was investing on my own, did terribly. Just did terribly. Bought a whole bunch of terrible stocks. Was just naturally attracted to garbage in the market, and they really helped me to hone the craft of investing. I became a regular poster on their discussion boards, attended some of their in-person meetings, and just really got to know the company and the people that worked there really well. And about 5 years ago, I was afforded the opportunity to become a contributor and a writer for Fool.com, and been doing that ever since.
I've been a fan of your writing for a long time. I think you wrote thousands of articles, if I'm not mistaken.
That's correct. Yeah.
That's a great number. I don't hear many people who wrote that much. So we appreciate it so much. So you always talk about your checklist in investing, right? So many people have a checklist. So we want to hear about your own checklist. What do you look for before you try to invest in a company?
Sure. So I've invested in a variety of ways over the year. I've been focused on dividend stocks at some points in my life. I've been focused on cheap stocks at some point in my life. And slowly over time, I've come to realize, after looking at my own returns and the returns of some of the best investors that I follow, that really the way to make money in the market, the way to make big money in the market over long periods of time is to buy the highest quality companies that you can find. Period. Like when you look at market studies, it shows that a minority of companies, a select few companies, are the ones that drive almost all of the market's returns over time. If you're looking at an index fund like the S&P 500 or the Wilshire 3000, or you don't see that. All you see is the entire index going up over time. But if you kind of drill down, you see that there's a select few companies that really drive the lion's share of the returns. And those select few companies tend to be really awesome businesses. So what I did for myself is when I became a member of the Motley Fool, you just get ideas thrown at you nonstop. And when I became a contractor for them, I got access to the entire website, every recommendation that they make. And it just becomes overwhelming. You're just, every single time you read a write-up on your stock, you're like, yes, this is the stock. This is going to be it, right? And then you read up another recommendation from somebody else that's smart. You're like, yes, this is going to be the stock. And for me, it just became, I was trying to keep track of all these things in my head. Like, how do you determine that you have two stocks that you're determined? Like, how do you determine which one you're going to invest in? And I would be like, well, this one, great growth. Well, but this one, really high gross margin. This one, run by its founder. This one has a bigger addressable market opportunity. And it just became overwhelming. So what I finally realized was a good idea to do was I wrote down all of the business characteristics that I thought were the most important and the most attractive. And then I wrote down all the business characteristics that I thought were horrible risks, like things that I did not want to see in an investment. And then I went through the process of ranking the business attributes that I found most appealing and most importantly. And then I did the exact same thing on the risk side. And then I shared that work publicly with the Motley Fools community and on Twitter. And going back and forth with other smart investors, I kind of came up with the current version of my quality checklist, as I call it. And it's a system that I can put any stock through, and I come out with a ranking score on the other end. And I've been doing this now for several years, and I've ranked hundreds of stocks. And I check for things like how strong is the balance sheet, right? I want stocks with lots of cash and no debt. How high is the gross margin? Is the gross margin over 80%? That's really good. I would rather invest in a high margin company than a low margin company. Is it profitable? Are the returns on capital? What is the competitive advantage that this company has? Are there signs of historic signs of optionality, which just means the ability to launch new products or new services to open up new revenue streams? Is it the top dog and first mover? Is the market itself, is the market that's in growing? Is there operating leverage ahead? Is the founder still involved, et cetera, et cetera? There's a whole bunch of things that I look for. And I go through, whenever I come across a new stock idea, I go through and I rank them top to bottom based on all the things that, all the attributes that I like. And then I subtract for all the attributes that I don't like. And that gives me a quality score at the end. And I use those quality scores to judge which stocks I should invest in and which ones I shouldn't. So by coming up with this system, it gives me a relatively unbiased way of judging stock opportunities against each other. And whenever I'm going to be deploying capital, I look at my checklist and I try and buy whatever is the highest combination of high business quality, high long-term growth potential, and lowest valuation at any given time. And I kind of rank all my stocks and I say, okay, this stock or these few stocks meet the highest quality, highest potential, and lowest valuation right now. And that's what I buy. And then I just do that over and over and over again. And I know that I'm going to be wrong. I'm just going to be wrong. That's just a part of investing. But if I'm right just a few times and I hold those companies voraciously, just like the entire market, my portfolio should outperform over time, as long as I don't sell the best companies that I buy.
Well, that's a great checklist, and you brought up selling, which I think is not talked about as much as buying. So when should you sell a quality company? How do you know? Do you determine when to sell before you buy the company itself? Or is there also a checklist for selling? So what are your thoughts on selling the stock? When should an investor do something like that?
Selling's a lot harder than buying. It just is. It's easy to second guess yourself. I mean, I've sold stocks that have then gone on to 50 bag. That sucks. That sucks. It really stinks to sell a stock for one price and then say, oh, instead of selling, what I should have done is put my entire portfolio into that stock instead. So selling is a really, really tricky thing to do. and it's easy to second guess yourself. I have a checklist that I use for selling, or there are 11 reasons that I will sell a stock. But overall, I've learned that I should have a heavy bias towards not selling. Like that should, like my default setting should be don't sell. So it has to be really pushed in the other direction to get me to sell a stock. In fact, the Motley Fool has research. They went back and they looked at all of their stock picks, all their buys and sells over time. And they have shown that their returns today would be higher if they never sold anything. That and their accuracy rate on selling is pretty high. Like if they say sell this stock, it has a really high probability of going on to lose to the market. However, they have sold a few companies that then went on to, 50x, and that single selling decision like overrides all of the good ones that you made. So first, just start by understanding that selling is incredibly complex and hard. With that in mind, here are the 11 reasons that I will sell a stock. Number one, and it's the most common, I was wrong. The reason that I bought a company in the first place was wrong. Most recently, I was a shareholder of a company called Grubhub, which is a food delivery company. I thought that they were the top dog in the food delivery space at the time, and I thought the food delivery industry is naturally going to be winner take most. People want to order from a place that has the most restaurants. Restaurants want to partner with the company with the most patrons. That was Grubhub. That was wrong. A company called DoorDash came in and just ate their market share. So I saw a formerly profitable high growth company become a low growth unprofitable company. That says, okay, I was wrong. I sold the stock because the original reason I owned the company proved to be wrong. Number two, accounting irregularities. If there's something that comes up that says, oh, we have to restate our financial statements, you're dead to me forever. Why am I going to bother with a company where I can't trust the accounting when 99% of the companies that are on the public markets, I can trust the accounting? Number three, if there's a mega acquisition that I don't like, and mega acquisition, by mega, I mean relative size of the two businesses. So when Apple bought Beats, this is directionally going to be correct. Apple was like 500 billion and Beats was like 3 billion. Even if Beats was a zero, like it's irrelevant to like Apple, the market cap. They're so gargantuanly different size businesses. When Teladoc bought Livongo, those are two companies that were about 15 billion. So that was like a merger of equals. If I was an investor in either, and I didn't like the one that was being acquired, that's a thesis changing moment for the business to say, okay, I used to own just Teladoc, and now I own Teladoc and Livongo. So that would be something that if I didn't like that acquisition, I would say the thesis here has changed. I'm going to sell. Number four is the thesis. The reason that I bought the stock is complete, right? I said, okay, this company is going to capture this market opportunity, and then it captures the market opportunity, and then there's no new market opportunity for it to go after. So if a company is growing, let's just say it's growing at like 30% per year, and just the relative size of the company gets caught up, and then the growth rates slow substantially because it has executed. A company growing 30% per year can start growing at 3% per year eventually. Like Coca-Cola, its high growth days are over. It won the soda wars. So if there's no second act, if there's no second market opportunity that is going to drive the company's next phase of growth, I will declare victory and move into something else. Number five, if the culture deteriorates, so a founder leaves, a beloved CEO leaves, and a new person comes in, and you just see a mass exodus and the business stops executing. Cultural problems are really hard to fix, so that can be a reason to sell. Number six would be extreme valuation compared to the market opportunity. And this one's really tricky. If I see a company and its market cap is 100 billion And I just can't think, if I'm like, wow, if this company is wildly successful, I could see it being a 150 billion company one day. There's not a lot of room there for like the company is like almost already captured all of its market value compared to what I would think. A high valuation, but I think the company can still 10x is I would mind the high valuation. A high valuation, and I think maybe there's 50% upside max. That I would think about selling. Number 7, the company is too large a position for me personally. So I don't like to hold more than 10% of my net worth in any given stock. If it gets above that number, I don't mind trimming it. Number 8, I'm no longer interested in following the business. I don't mind selling. There's tons of other businesses that capture my attention. Number 9, it's acquired. If it's acquired, might not want to own the company that's doing the acquiring. Sometimes you don't even get that option. You're paid out in cash. Number 10, I want the money for my personal life, AKA the reason that we invest in the first place. We invest so that we can spend it on something later in life. So if I've sold stocks to pay for real life expenses. The final one is tax loss harvesting. If I'm down on a stock, and there's a loss on there, sometimes it can make sense to sell that stock, especially if you have no longer interest in it, to lower your tax bill.
The mathematics of selling is extremely hard. Like if you just sell one stock, which gains a huge gain, it just doesn't make sense to sell at all. Mm-hmm. But nonetheless, you should sell. Markets do really humble you. You should always say that you're wrong when you are. If you don't, you'll be just like the perma bears or the other people who've been wrong so many times. I remember the Motley Fool talked about MercadoLibre, and also you talked about it. So it has been a wildly successful stock pick. So what drove what did you like in MercadoLibre at that time? What made you?
Yeah, so MercadoLibre, depending on the day, is either my number 1 or my number 2 holding. I've been an investor in MercadoLibre for 9 years, 10 years, something along those lines. So it's been a phenomenally successful company. The simple answer there is I didn't have my checklist when I invested in it, but if I did, it would have checked nearly every box that I look for. It was the top dog and first mover in an important emerging industry. I had a wonderful founder, CEO. It had very good economics at the time. Even years ago, the economics of the business were really good. It was a winning stock. The stock had already crushed the market when I became a buyer of it. And I'm a big fan of investing in companies that have already beaten the market, because that's a really good sign that the company is doing something right. The opportunity ahead of it was absolutely massive, and it had clear signs of optionality. When I invested in MercadoLibre, the thesis was it's the eBay of Latin America. They connected digitally online buyers and sellers. If you look at the thesis today, the thesis is it's the PayPal of Latin America with an eBay kicker. Like the thesis for owning the stock has switched. Now, Mercado Pago, which is the company's PayPal-like system, that existed when I first invested. It was just a tiny part of the business. More recently today, they have their hands in all kinds of stuff. They're getting into the shipping and logistics business. They even have an asset management division that they're going to be that they're growing in. So you can take your funds that you've have on Mercado Pago and you can invest them in the market. Right now, that business is like a rounding error for the company. Could it be something big by 2030? I mean, it's entirely possible. So it's just that MercadoLibre had all of the hallmarks of things that I looked for in a great business. And that's why I bought it and have owned it. Now, MercadoLibre is a great stock to learn lessons from, because if you look back at the history of that stock, like, holy cow, it's up and down. If you just look at the stock charts from today, you're like, wow, this thing's a mega winner. It's up like, 30x or whatever. Must have been easy to hold. The company is regularly just crushed down 20, 30, 40, 50%. It goes through these extreme gyrations. So that company has been a great mental training for me to just be like, you see your investment go up, down, up, down, up, down. But as long as you were focused on the underlying metrics, the number of users that they have, the number of products that they offered, the number of revenue that they were generating, it's just as clear as day that the business is winning. And as long as you see that the business is winning, you should you need to train yourself to not mind what the stock does. You have to focus on the business results.
Loving this energy, Brian, honestly. And since you've been talking a lot about the stocks that you like, there's a huge excitement about Tesla going on globally. And you've been known to be a Tesla bull.
Mm-hmm.
So we'd love to ask you, how would you justify a current valuation with everything that's happening?
Mm-hmm. Tesla, well, first off, let's understand this. Tesla is the hardest company in the world to value. Period. Let's just start there. Where could Tesla potentially be by 2030? It's either insanely good or insanely bad. That's the range of outcomes for Tesla over the next 10 years is so unbelievably wide that it's just impossible to value the company. If you look, and it's easy to look at Tesla today and say it's worth more than all the other automakers in the world combined. That makes no sense. They're selling 0.5% of all the cars that are out there, and they're worth more than all the other companies combined. That makes absolutely no sense. And that's a completely logical point that's being made there. The way that I value Tesla is by thinking about where the future is going and who is likely to take us there. If you listen to Elon, he says that the company is essentially on the path to be a leader in autonomy and just transportation in general. Elon is hell bent on turning Tesla into a robo taxi company. If he gets his way, and if he is right about that, he may be, he may not. What happens to the company's financial statements? It goes from being a company that sells cars at a 20% or a 30% gross margin, whatever it is. Could the company go to being a software-like business that has margins that are in the 60s or 70s? It's possible. It's entirely possible. But if you are someone that gets scared by valuations, if you guys someone that gets scared by volatility and stock movements, I mean, just Tesla is not for you. There's no harm in taking a pass on it. I can tell you that Tesla has grown to become my second or third largest holdings, and that's a great example of if you would have asked me 9 years ago what's going to be your biggest winner, I would not have said Tesla. I just wouldn't have. Like there's nothing about this that said, oh, this is going to be a 100-bagger. But that's just what's happened. So in some ways, there's a lot of luck with investing in Tesla a long time ago. The Tesla that was then is nothing like the Tesla that is existing today. But I have Tesla is my number 2 holding. I personally think it's going to be a multi-trillion-dollar company someday. Multi-trillion. I think there is huge upside from today's prices. Where it goes between now and then, I have no idea. What are the odds that I'm correct? I have no idea. But if there's one person in the world that I would not want to bet against, it's Elon Musk. I think that Tesla has a tremendous opportunity in cars, in ride hailing, not to mention Tesla Energy. Those things could be baked into the share price today, or they could not. But man, if there's any company that's hard, like really super duper hard to value, it's Tesla.
Valuations in general, they are very, very, very tricky. You know, it's the most wrong ways of selling or buying are caused by valuations. So they are very hard. And with Tesla, I don't remember exactly what was the price a year ago and what's the price now, but I think the movement is like 600%. So how does one look at this and not say that the market just didn't know what it's doing or it's just overvalued now? So it just doesn't make much sense to me. But the thing you pointed out, which is you shouldn't bet against Elon. I mean, this is my only reason for buying. I just want to bet on Elon. I just think he will do what's possible to make it valued what it is. Whatever the market values it, Elon will do his best to make it worthwhile. So I wanted to ask you about the current dynamic that's happening in the markets, which is as yields are rising, most of these growth tech stocks are falling. So is this a new phenomenon? What should investors do? Should you care? Should you lower your tech stocks, etc.? Or is this just you shouldn't focus on this?
Yeah, that's a pretty macro question that you're asking there. It's about are rising interest rates going to cause tech stocks to come down? The answer so far has been yes, but I know that I'm not smart enough to be able to predict those things. I'm just not. I have no idea what is going to happen to any stock that I own over the next 1 year, 2 years, or even 3 years. I don't even try and guess. I have learned that no matter what I was going to guess, I'm wrong. If you asked me, I would have said the market was overvalued in 2017. 2017, it's like up, I don't know, 80% roughly since then. Think about what happened in 2020. We saw the fastest bear market in history, followed by just a few months later, people saying, is it the return of the 1999 dot-com craze? Trying to predict what's going to happen in the market over the short term is just insane. So I don't even try. The only thing that I focus on with what I'm doing is do the stocks that I own today, are they businesses that I want to own? Am I confident that those businesses will add new customers, more revenue, and have higher margins in 3, 5, and 10 years from now? And if I'm right about that, the stocks will be higher in 3, 5, and 10 years from now. That's just how it works. What happens to the stock, to any stock that I own over the next week, month, or year? I have no clue. You could tell me if you told me the future and said, Brian, your whole portfolio is going to be down 40% in a year. I'd be like, yep, okay, makes sense. And if you told me my whole portfolio is going to be up 40% a year from now, I'd be like, okay, nah, makes sense. I have no clue. I have no clue what's going to happen. But I do know that when stocks go up extremely quickly, they tend to mean revert and come down extremely quickly. And that's what we've seen. The tricky thing is there's been so many new investors that have gotten into the market over the last 1 month, 2 months, 3 months, 6 months. And the only thing that they've seen prior to this recent sell-off was stocks going straight up. Instant gratification. No matter what you buy, it just goes up instantaneously. And that can give you some false expectations about what actually happens in the market. If you go back in time and say, was buying Amazon on the first day of its IPO a good idea? Was that a good idea? The answer is yes. Maybe it doesn't get any better than that. Amazon has been one of the best performing stocks over the last 24 years. All right. How much value did Amazon create in any given year for its shareholders? I don't know the exact number, but it's somewhere around 25% or 30%, roughly. Somewhere around there. All right. So that means that Amazon was compounding shareholder wealth at roughly 2 to 3% per month for just a long, long period of time. And that's like as good as it gets, right? So I always think about that. Like if I'm extremely successful in my portfolio should roughly add 1 to 1.5% in value every month, roughly. But if you look at what actually happens to stock prices, they go up or down 1 to 1.5% every day, maybe more, maybe less. So the speed that wealth actually gets built and the speed that prices changes are just two completely different things. And you just have to train yourself to focus on the underlying businesses and the wealth that's being created that way, and just do your best to ignore what is happening with the actual stock prices. Those two things are not connected at all in the short term. Not at all. They are 100% connected in the long term. So you have to focus on, do I like the businesses I own today? Do I think they'll be bigger in 5 and 10 years? And just accept that, one, you're going to be wrong often, and two, anything that can happen to the prices in the short term, anything.
I remember 2017. I think it was the least volatile year, if I'm not mistaken. It was a very just straight up year. And with 2020, we get the most famous saying, stonks only go up, right? So it's very hard to adapt to that mindset now. So how do you train yourself to be a long-term investor? How do you adapt to that thinking in 5, 10-year horizons? Most people think at the maximum 1 year. So how do you train yourself to be an investor that focuses on the long term?
There's no shortcuts. I wish I had a shortcut. I don't have one. And I know that because I myself was focused on the extreme short term when I first started. The only thing that I wanted to do when I first started investing, and I put that in air quotes for a reason, was can I sell this stock in 1 day or 2 days to somebody else at a higher price? Period. It's the only thing I cared about. I was like, who are these suckers buying Coca-Cola and Microsoft and waiting for their dividends to come in? I want to buy things that are going up instantaneously so I can get rich right now. I mean, I can just speak for myself. I just had to learn the hard way. I just had to get my teeth kicked in the beginning. I just had to slowly change my mindset from get rich instantaneously to build wealth slowly. It's not an easy thing to do. It's not. But the more I studied stocks and the more exposure I had to great investors, and the more I looked at my own returns and the returns of those people that I greatly respect, the more I just internalized business results lead to stock results. Anything can happen in the short term. And even at a slow wealth building rate of, let's say, 6% per year, you can still become incredibly wealthy in your lifetime if you start early and you save often. I'm guessing that most of the people that are going to be watching this are skew younger, under the age of 40. That means that you have decades ahead of you to invest and take advantage of the stock market. If that's you, you should focus all of your effort on saving as much money as possible. Saving as much money as possible. That if you want to speed up wealth creation, save more, make more money, spend less money, and save as much as you possibly can. If you can do that, and you can live very cheaply and put a lot of money into the market over a 5 or 10 year period, the compounding will eventually kick in, and the compounding will eventually take over, and you will be very, very wealthy 20 and 30 years from now. But there's no shortcuts. That's just how the market works.
Brian, you've been a veteran in the market for the past 17 years. A lot of humbling lessons. I'm sure that a lot of our listeners will probably face it later in the future, but great advice. One of the questions we wanted to ask you, since you've been in the market for long periods, is what are your thoughts about what's happening in the SPAC arena? We've been seeing record filings for SPACs in 2020 and now in the first quarter of 2021. So that's one of the first things we wanted to ask you, along with, should investors look abroad of the US market, and they should hold cash? What are your thoughts? So 3 different points we would like to hear your thoughts.
So the first one was on SPACs?
SPACs, correct.
Mm-hmm.
If they're looking abroad of the US market. And the thirdly is if they should hold cash.
Okay. So let's start with SPACs. So SPACs are they're just an interesting development, but they don't change really anything about what I do. I'm not someone that buys a lot of IPOs, a lot of new companies that come out. I am the type of investor that wants to see a company be public for a little while before I will buy it. But the more SPACs that are out there, I mean, in my opinion, that's a good thing, because it just means more companies are coming to the market, and we get more chances to look over to more companies to potentially invest in. And while there have been a lot of SPACs that have come on, many of them are good businesses. They have recurring revenue. They have high growth. They have big market opportunities ahead of them. So I don't really care how a company comes public, IPO, direct listing, or a SPAC, because I'm not going to be a day one buyer. But the more companies that come, I say bring them on. In fact, many of the best investments that I've made have been in relatively new IPOs, companies that are on the market in the last 1 to 5 years, because that means they're typically early on in their growth cycle, and I like to see them be public for a little bit so I can get a sense of how do they perform when they're a public company. Being a private company is one thing. Being a public company that has a report due to the investors every 90 days and a number hitting over your head, that changes things. And not every management team is up to it. So overall, with SPACs, I'm pro it. Question number 2 was about international diversification. So I am based in the U.S. and almost all the investments that I make are in U.S. based companies. But I recognize it's a big world out there, and many companies. I mean, U.S. investors are spoiled because many of the greatest companies from around the world choose to list in U.S. exchanges. So I get access to them, but I'm more interested in just investing in the best businesses I can find, period. And I don't really care what part of the world they are located in. And there's also a lot of great companies in the U.S. that one of their biggest opportunity is in international markets. So those companies have already got their economic engine working in the United States, and they're going to see if they can take what their success that they've had in the US and replicate it outside the US. So I don't think, I'm not like the type of investor that's like, oh, I have to have 30% of my capital put in companies that are outside of the US or anything like that. I just want to own the best companies that I can and not really care where those companies get their revenue from. Number 3, with regards to cash management, I've heard both sides of the arguments. I know investors that are always 100% invested all the time, and that is their style. And they just, whenever they have cash, they want it invested. Cash invest, cash invest, cash invest, and that works. That works great. And mathematically, that is the correct way to do it because you are compounding your wealth for the longest period of time. I know other investors that have 30% or even 40% of their portfolio in cash, and they are more active with the timing of buying. And that can work great for them too. My personal style is kind of a hybrid. I have anywhere between 1% and 10% of my portfolio's value in cash at any given time. And when I find opportunities that I want, I will deploy it. If the market is down big, I will try and deploy even more. But I also have a part of my retirement funds are always buying. So those are just set up on automatic buying on a dollar cost average basis. So how you choose to do it, what your personal philosophy is on cash management is more about you and what type of investor you are than here are the rules that you need to follow. But overall, I'm a huge fan of writing things down, making rules for yourself, and then following those rules. Because when you're writing things down, you're thinking slowly, you're thinking unemotionally. And then when you actually have to employ them, it's like if you have those rules that you set for yourself when you're in a calm, relaxed state of mind, it's much easier to follow, to do the right thing versus when you're staring at a screen and you're seeing red numbers or green numbers and your emotions all over the place. So whatever you want to do with your cash management strategy to be, write it down and then follow those rules.
Write it down. That's a great piece of advice, and I'm following it personally. We were curious along the way, what are a deal that went south, but you learned a lot from, and what's a deal that you profited or benefited from a lot in the positive direction? We'd love to hear that along the way.
Sure. Boy, there's lots of choices for deals that went south because I have bought in a lot of bad stocks. The deal that went the worst, I will tell you about that because the biggest lesson that I've learned in investing is when I lost the most money on a dollar amount. In the US, there is a pipeline company called Kinder Morgan, and they are primarily a natural gas pipeline operator. And if you put them through a checklist, boy, is there a lot to like. Founder-led management team, high-quality customer base. They have these things called take-or-pay contracts, meaning they didn't care, in theory, what the price of oil or natural gas was. They just got paid to move it from point A to point B. So as long as they fulfilled their contract on the moving it, they got revenue. When I saw that and I dug through and I was like, profitable, pays a dividend, run by a founder, the revenue is like locked in, guaranteed. I said, this is as close to like no brainer as I've ever seen. I was so confident in it that I made it my largest position with my capital. So I bought a 5% plus position, and I leveraged into the company with a bullish option position called a synthetic long. A synthetic long is basically pure leverage. It's basically saying, I am so confident in this company that this stock price is going up that I will commit to buying it if it goes down. When I did that, it worked. That strategy worked great for about 18 months. And then after 18 months, the price of oil went from, directionally, this is going to be correct, 100 to like 30 or something like that. The oil market was oversupplied by a tiny little bit, and energy prices collapsed. And Kinder Morgan stock went from like 45 to 40 to 35 to 30 to 25 to 20 to 15. Okay, and I was watching this sickening slide, and I was like, what is happening? This makes no sense. The price of energy does not impact Kinder Morgan at all. It should not matter. It turns out when you have a contract with somebody, that contract is only as good as the other person's ability to fulfill it. It didn't matter that Kinder Morgan was insulated from the price of commodities. What mattered is that its customers could actually pay. And its customers were hurt so bad by the falling energy prices that many of them were seeking bankruptcy protection, and they were doing everything they could to protect themselves financially. So many of them had to go to Kinder Morgan to renegotiate contracts or ask for forgiveness. And the market was smart enough to see that and knock the stock price down significantly. That taught me numerous lessons. One, no matter how confident I am in a stock, I could still be wrong. So I have since learned to layer into positions slowly over time. And my biggest positions, my biggest ownerships have to earn their spot. I don't put capital into them to make something my biggest position. I put a little bit of capital in, and then for it to become my biggest position, it has to do the heavy lifting. It has to go up a lot for it to become my biggest position. The second thing I learned is to avoid companies where market prices that are outside of the company's control matter to the thesis. So if you are a gold miner and you're the best gold miner in the world, if the price of gold goes down 50%, your stock's going down. Period. You are heavily reliant on the price of gold for your company to do well. They have the management team could be the best management team in the world, but the stock is going to fall if the underlying commodity that it sells falls in price. So I have since learned to avoid companies that are reliant on some outside force, outside market price for them to succeed. So this means I avoid airlines, because a major component of airlines is fuel prices. Fuel prices go up, they make less money. Fuel prices go down, they make a ton of money. I avoid energy producers, oil and gas companies. I avoid banks. Banks are heavily reliant on interest rates. They have no control over interest rates. Those are set by third parties. So those two lessons were learned from losing a lot of money on Kinder Morgan, but I think that those two lessons are going to pay dividends for the rest of my life, or at least that's the lie I tell myself to make myself feel better. So that's the downside. I mean, my biggest winners of all time have been Netflix, Tesla, and MercadoLibre. All three of those companies, founder-run businesses, small when I purchased them, absolutely massive market opportunities and varying degrees of economics. So Tesla, the economics were not good, but MercadoLibre and Netflix, the economics were pretty good. But those are just companies that I bought in them early. I believed in them, and I just held them voraciously. And the market just really picked them out to be, yes, this company is succeeding. And in all three cases, I just put a little bit of money in up front, just a tiny little bit of my portfolio, and I added to them over time. And they have since become not only my biggest winners, but my biggest holdings. They would not have become my biggest holdings if I sold them. If I sold them at any point, if I said, thesis is played out, this is wrong, which would have been easy to do. These stocks were up 500%. And how many people would be tempted to say, the easy money's been made, I better take my profit. And I would have missed out on tremendous market beating gains from there. So the lesson there is if you find something that has tremendous long-term potential and is run by a founder-led team, put a little bit in and don't sell.
Those are great lessons, Brian. You talked about banks. So would you not even consider like small regional banks? Most of them have, in my view, great economics. So what do you think of small regional banks?
The banking sector, if you look at some of the biggest companies in the world, many of them are banks. So the banks have good economics. There are things to like about the banks. I know for myself, other people are going to make money on banks. I'm not. Other people are going to lose money on banks. I'm not. It's just not a sector of the market that I care about, or that personally sings to me. I would rather invest in software companies and medical device companies than banks. But I see nothing wrong if the banking sector interests you to investing in small or regional size banks. You can make money in them. But for me, they just don't interest me.
A lot of interesting lessons. Do not be afraid to average up. Do not be afraid. Let your transactions earn up. Let your positions earn up their position in your wallet. So that's a great lesson. So for our last question of the day, we would love to ask you, what are some key advice that you would like to give to young investors?
Start. It's probably the most important thing. Just get the ball rolling. When you're a young investor, I kind of hinted at this before, but when you're just starting out, the most important thing is that you get your income heading in the right direction and you get control over your expenses. If I had the next Amazon, right? If we knew what the next Amazon was today, but you did not have any capital to buy it, or if you did not have the capacity to hold it because you needed that money later in life, that information would be useless to you. Investing information without capital to go out and buy that thing and then hold it for a long period of time, you won't become wealthy. So if you're young, if you're just starting out, really focus and put a lot of effort into growing your income and slashing your expenses. It just makes such an enormous difference early in life. If you can save $500, $1,000, $2,000 a month, and if you can do that for a couple of years, the economic engine that you have growing, it's kind of like building your own money tree. Like once your portfolio gets going in the beginning and time really starts to take over, it's going to be a tree that like sprouts money and gives you net worth for the rest of your life. So if you're young, focus on that first and foremost. Number two, as you start to make investments, there's no need to pick your own stocks if you don't want to. If you are just not interested in following companies and understanding psychology and being proven wrong, there's absolutely nothing wrong. In fact, most people should just put their money into index funds, dollar cost average, and they will do fabulously later in life. If you are interested in picking stocks, you have to be willing to look silly and be humbled, because you are going to be wrong often. But it's more about making mistakes, learning from them, and connecting with other investors so you can understand what you should and should not do. But if you're young, you have such a massive advantage. You have the ability to buy stocks and hold them for long periods of time. Don't waste it. Don't be in a rush to become instantaneously wealthy tomorrow. That's not how the market works. And if you can't stomach huge, occasional, random, unexplained drops, you will do poorly.
This is some great lessons, and they're based on experience. So, Brian, you've given us a lot of your time. Thank you very much for being generous in sharing the information. For this energy, we really appreciate it. I'm sure our listeners would love to hear it. And any final words you have to our listeners?
No, I want to say thank you for having me. Glad to get some support from your neck of the world. That's awesome. This thing you guys have going on is fantastic. So keep it up.
Thank you very much, Brian. Please, everyone, follow Brian on Twitter, Brian Feroldi, a very interesting human being, and always have been fans since the Motley Fool. So thanks again, Brian, and have a great